I guess even before I answer that question is, why did I jump into real estate, as that will help kind of guide that conversation. My wife and I were having the conversations about having a kid. We knew our income had a ceiling, that working in the corporate space, I was not commission based. My income was capped until the next promotion cycle.
All right, guys, I'm super excited today. We've got a guest that's going to just blow your minds with what he's been able to accomplish in the last few years and, his short investing career. I actually met Karl Krauskopf, who is our guest today, last year. I was invited to go on a hike on the Enchantments. And if you live in Washington State or even the Northwest, you've probably heard of this. It's a 20-plus mile hike through the North Cascades. Super difficult. And I found out a week before I was going that I'd be going with, and Karl was one of the folks who was there. And me and Karl ended up walking about 10 miles, of that hike together and really just kind of hitting it off and getting to know each other. And I was able to learn a lot about Karl and his story and how he was able to recently retire at that time from his really successful career, 10-year plus career in healthcare, strategic business planning. And, just had a really successful career, but he was actually able to transition that into full-time real estate investor. And that was something that I was really, hoping to do. I still am in the near future, and many of you listening today are as well. So, Karl, thank you so much for coming. I really appreciate your time today, and we're super excited to have you here.
My pleasure, and I completely forgot that that's how we met on the Enchantments. I'm pretty sure we had at least one or two mountain goat experiences that still haunt me. I did that hike again this past July, and I am the brunt of all of the jokes when it comes to mountain goats, and it's just I'm still terrified of them.
Yeah. So hopefully, I know you guys have that as like an annual trip. I'm looking forward to joining again next year.
Likewise, so. Yeah, we're excited about it. So, yeah. So, Ian, I think one thing that we'd love to talk about is the whole Seattle market. Obviously, a couple other things, macroeconomically speaking. Right, we're in November 2023 right now. What's going on in not only the national market but also the local market here, Seattle and Washington in general. Happy to expand on that as well.
Yeah, definitely. And before we dive right in, like I said, you had a very successful career with your W-2. What did your career before real estate look like? And tell us a little bit about your upbringing. Did you have mentors in real estate, and how did you kind of get into that?
Sure. Sure. So my wife and I, we grew up in the sunny coast of southwest or southeast Florida. Absolutely loved it. We spent the majority of our lives there. We had a quick layover in Dallas for work. My corporate job, I worked at a healthcare company where I was back office, I was business services, so did a lot of strategic planning. The tail end of the career there, of the 10-year career, was chief of staff in helping to build out essentially a provider and insurance provider business that offered services to physicians and hospitals and things of that nature. And it was a really, really complicated, really convoluted business plan. And so it was really difficult to help grow that business because it was, again, something that was complicated that the physicians, the hospitals didn't really understand. So the majority of my career, I was trying to explain these complex theories, these complex business plans to physicians who did not necessarily, their business was to operate, to provide quality of care to their patients. It was not to understand business plans, and it was not to, how can I completely change how I'm being reimbursed by healthcare and insurance companies. And so again, it was this kind of long, drawn out process of winning clients and working with clients in that space. Okay. But for my upbringing, I didn't have any real estate experience. I didn't have anybody in my life. I had some uncles that did quite a bit of work in the real estate space, but they never, we were never close. We never really talked about, what it was that they were doing in the real estate space and how it could help and drive success in my life. I was always one-track mind focused on the healthcare space. Okay. I've been in Seattle now for 6 years. And it's only been, I've been full-time now at this point for about 2.5 years. And before that, I was doing some side hustle stuff, right? Flipping homes on the side, building homes on the side. And at a certain point, it was a decision that my wife and I made for our family to say, hey, it's time. It's time now to separate ourselves from the corporate space and really allow me to focus in driving and growing my investment business.
Okay, that's amazing. So you had, like I said, a successful career, but you were starting to dabble a little bit in the fix and flips. Did you do any long-term rentals, or were you kind of doing two active investing strategies in terms of W-2 and then fix and flips?
Sure. So I guess even before I answer that question is, why did I jump into real estate, as that will help kind of guide that conversation is, my wife and I were having the conversations about having a kid. We knew our income ceiling, or rather our income had a ceiling, right? That working in the corporate space, I was not commission based, that my income was capped until the next promotion cycle or the next bonus, which, I would not necessarily have direct impact whether or not I could have a bonus, right? It was company wide. The company made decisions whether or not they were going to give out bonuses. So and my wife at that time was a school counselor, right? So in being in the public schools, you can look literally 10 years out in the future, and they have a schedule, an income schedule for what you would be earning 10 years from now. So we knew we could essentially track our income for the next 10 years, barring any kind of major increases or decreases. And that just wasn't enough for us, right? That wasn't enough for us to want to bring in another human being who we knew would have college expenses, weddings and all this kind of stuff that we wanted to be able to provide to our daughter. And, we didn't feel comfortable going into it. So we looked at what are the other types of way to generate income. I thought about day trading stocks. This was before, we're looking at about 5 years ago, 5.5 years ago. This was before crypto was a big thing. And, I tried a little bit of everything for a short period of time, probably about 2 months. And then somebody introduced me to the idea of owning small multifamilies in lieu of rental income. And that literally blew my mind when she told me you can own duplexes, triplexes, and quadplexes. I was like, there's no way. Those are companies that own those, right? No, it's individuals like you and I. So completely blew my mind. She gave me a book, and I absolutely devoured that book. Spent the next 6 months self-educating myself, right? Reading books, podcasts, going to local meetups, and I absolutely fell in love with it. My first purchase was a duplex in Spokane. And it was great. Bought it sight unseen, and was a terrible decision to do that. Do not recommend buying sight unseen unless you are very familiar with the area. And then I moved into the active flipping after that.
Okay, amazing. Do you still have that Spokane deal today?
No, I sold it in October 2020, and we did okay, right?
Okay.
I bought it in October of 2018, and it was it was just a doozy, right? I ended up buying it with one vacancy, which was planned. Placed my first tenant. That first tenant I had to evict within 3 months for non-payment. It was a terrible screening job. Once we evicted, it was a $15,000 rehab bill because of they had nine cats who just completely ruined the entire apartment. So it was a tough first deal, man. I'll be honest, but once we got it stabilized and new tenants placed, then it was the nice $500, essentially $500 net cash flow per month after that. That I was like, this is kind of nice. I can see myself doing more of these.
Yeah. Yeah, that's really interesting in terms of, for you, the fear of staying the same was greater than the fear of change.
Oh, absolutely.
In that situation where you have a child coming, a growing family, and so many people would see that as fear of, making any moves that could ruffle any feathers or put them in a bad position. And you were able to forecast out what your life would look like. It was very predictable, and that life wasn't good enough for you. You wanted more for yourself and your family, and you were willing to take the risk to get that. So that's, it's amazing that you were able to do that. So
yeah, absolutely. And if that wasn't enough, at the same time as I finished that eviction, we had our kid, we had our daughter, and also 2 months after that, decided to buy my first flip property. This was in Everett, so a suburb north of Seattle, and it was a hoarder home. We had, imagine this, 4 40-yard dumpsters filled to the brim worth of junk out. It was each of the rooms, so it was about a 3,000 square foot home in Valley View neighborhood. Gorgeous home, beautiful home, overlooked the Cascades, absolutely immaculate after we were done with it. But man, I have this attraction, rather the universe attracts cats to me apparently, because we had to deal with just an insane amount of litter boxes, completely used, completely uncleaned litter boxes, floor to ceiling in some of the rooms, just borderline hazmat suits. And it was just atrocious, man. It was, again, four 40-yard dumpsters full of just junk. That was a spicy one, right? We had to do a lot of creative financing on that in order to buy the first flip. Made $60,000 off of the first flip, which was, to me, a complete win. It was, how do we do this again? How do we do more of these flips? Right. Mind you, at the time I was making about $125,000 net income from my corporate job. So it was like three months. I made $60,000, half of my full year salary at my corporate job. Let's go. Let's do some more of these.
For sure. So you hit on a good point there in terms of your first deal was not out of state, but it was out of the area. You required a property manager that was not, within an easy drive for you.
Yep.
What would you recommend? I know there's all sorts of people. We live in a Seattle market where it's super expensive to get into. Rates have just made that even harder. And a lot of people that we talk to are saying, forget Seattle. We're going to a cheaper cost of living state, maybe Ohio or the Midwest. And, while Spokane isn't all the way to the Midwest, it still resulted in some of those challenges in terms of you don't have boots on ground there and it's a little bit more difficult to manage. What would you say to somebody that's saying, forget Seattle, I'd rather just go to the Midwest where I can actually afford something? And
I would say don't necessarily write it off. Don't write off the high cost markets. Depending on what you're working with from a capital standpoint, if you're a solo operator, then you may be forced to go to lower cost markets. But that being said, look within your same state, right? So, there's plenty of properties here in the state of Washington that you can go out and get $100,000 per door, and it cash flows nicely, and it has I would say, somewhat of a West Coast appreciation. Right, like Lakewood, for instance, which is a suburb of Tacoma, Spokane, which we talked about, Wenatchee. There's plenty of cities where you can get low $100,000 per unit, which again is is comparable to some of those Midwest markets. But you don't have to necessarily take a flight out. It's not a day of travel. I'm absolutely not opposed to remote investing at all. I think remote investing is great. It means that you have to have your systems and processes in place in order to make it work, right? With my 12 unit in downtown Seattle, if my leasing agent doesn't show up, well, guess what? I can drive there and I can make the appointment happen. Now I can't do that with Ohio, which means we sure better have a solid property manager, solid reliable managers in place to get everything done, because I can't necessarily force the project to be successful by physically stepping in and making the deal work. So remote investing certainly has its advantages. I don't disagree to that. But I would say also is that, first look locally, right? Because the hardest part about making an investment successful, in my opinion, is really understanding the market, right? The market has so much more impact to the success of a project than most people give it credit. And, if you know your market really well because you live there, you can probably, and if it's a good growing market like Seattle, then you could probably do a lot better than just picking a point on the map and investing there, just because it's a low cost to acquire.
Right. Yeah, I totally agree. I mean, having the ability to drive those streets, know every single neighborhood, know exactly where the fixer houses are, the local zoning laws, and just having that advantage in your own backyard is such a huge thing that I think people often overlook just because it's expensive and that's the first, they kind of stop there. Mm-hmm. But for people that I've seen that have invested in the Midwest or, out of state, a lot of the time, like you said with that Spokane deal, the first few deals are very difficult because you're building your processes, you're getting your property management in place. But maybe after you've done your first few, then you've got the systems and the advantages of the neighborhoods, and you've flown out there a few times. So after your first few, you've got that set up. But you need to be prepared for those first few deals being a little bit painful and having that learning curve in order to be able to develop the that competitive advantage of really knowing the market.
And I think from that perspective, it's like go buy in your own neighborhood, go buy in your own state, get those lessons learned locally. So that way you can apply those lessons across the country.
That's a great point.
Right. Instead of completely just guessing on a market, guessing on a neighborhood. Right. And I think that we're talking about two extremes right now. There's certainly a middle place where, for me, for instance, I grew up in Florida and I spent, 5 years in Dallas. I could feel confident. I know those cities well enough to say I'm only going to invest in Plano or Frisco or submarkets within the Dallas market. And again, I'm familiar enough with that because I lived there for so long that I can confidently go in there. Now, that being said, you still have to have, again, in my opinion, especially on the small operator side, you have to have a manager. You have to have boots on the ground. You don't try and self-manage this stuff. You will get crushed and you will be sad.
Yes, well said. So Karl, tell us a little bit, right, you got into the fix and flips, then a few years ago, I know you were having a lot of success with the small developments, the townhomes, like we said, taking advantage of the local zoning in Seattle, buying a L zone or townhome zoned property, putting up 5 or 6 townhomes and making really great money. And then that transition has also kind of gone into some of the multifamily, the syndication type work. And if you could talk a little bit about kind of how that transition has been for you from the fix and flips to the duplex type stuff to the townhomes, we'd really love to hear about how that's gone for you. And
sure. So to put it in perspective, I flipped about little less than 30 homes over the first 4 years, over the first 4 years, flipped about 30 homes in the Seattle market, built 13 townhomes again in Seattle over the period of, I think it was year 4, right? So now we're in year 5. So year 4, we did 13 townhomes and a handful of DADUs, the backyard cottages, and did really well with those. As you mentioned, taking advantage of the local zoning and just having strong partners, strong builders, strong subcontractors in the market, great relationships. Again, that's the value of just doubling down in one market, especially as a sole operator. But Ian, to your point, then it was, so rewind a little bit. We are now in October 2020, 2021, right? October 2021. I've successfully exited one development deal. I've picked up another development deal, and Fed Powell comes out, Janet Yellen. We're talking about the Fed, the Federal Reserve, and we're talking a lot about inflation, right? Inflation before October 21 was transient, right? It's we're just talking about inflation. It's going to go down really soon, guys. Nobody worry. Do not worry. And then October 2021, Chairman Jerome Powell comes up and says, "This is kind of sticky, guys. It's not transient anymore. We're going to have to start doing something." And so that was that was the initial hawkish view that Fed Powell came out and Chairman Powell said. And so at that point, that was me like, I got to stop buying these short-term deals. I got to get into long-term deals. What does inflation do? We know that inflation increases rent. We know that inflation also probably, if left unchecked, is going to have to be brought back down. And we know the only way that the government's real lever to pull there is restrictive monetary policies. So what does that mean? Increased interest rates, which mean increased cost to borrow. If we, at that point, we were not on any variable rate debt, but certainly a lot of people were still getting into variable rate debt at that time, right? October 2021. So I back up. I stopped buying any more development short-term deals. I went through that self-education process again of about 6 months reading books, really understanding what it is about the multifamily market, what it is about the rental market that you can be and how to be successful in that, right? Really understanding asset management and, again, just devouring as much as I could on the operational side of owning apartment complexes. Because I knew at that point I was already trying to get towards a scale, right? Scaling up in terms of unit count, in terms of economies of scale. And I knew, again, apartments were the next phase. So bought my first apartment complex a little more than a year ago, a 30-unit complex. Closed on another 12 unit in Seattle again earlier this year, and working on a couple others right now. Hopefully, going to be getting to that 100 unit range within the next 6 months. Wow.
Okay, that's amazing. The way that you've been able to transition that. Also, you talked about that was the second time, probably more than that you've kind of looked at where you're at in the market and said, I need to do a deep dive into exactly getting all the education that I need to be able to best deliver results in this type of an environment.
Right.
And then you took action immediately. So, being able to adapt is super important, as you know, as a real estate investor. And, you're a great example of that. So,
yeah, I think too often we as, business owners, we as investors, we get caught up in this idea of let's just keep going. The problems will solve themselves. The market will solve itself. I just need to buy another flip. I just need to buy another development. I just need to buy another duplex. I just need to do wholesale another property, right? It's this mentality of the market will correct itself, but what I'm doing is fine as long as I'm doing it really well, right? And I think that there's a very select few operators out there that can still flip really successfully in any market. But I would venture to say the vast majority who are flipping are not going to be doing really well in every single market. Yeah. And I would be remiss to say that I would certainly fall within that camp of, in any market, I'm not flipping right now. Because I know that I would not be successful in it. I know that I would not be successful in flipping right now as one strategy. Yeah. So keep an eye on the market, understand what's happening in the market macroeconomically, globally, geopolitically, really understanding what's happening and how it's impacting your particular strategy, your particular business.
Love it. So, one other thing that I've really enjoyed, following you as you've built your multifamily business is right now, if you look on the news, everything is saying multifamily is in trouble, commercial real estate's in trouble, office buildings are in trouble. And here you are taking this contrarian approach. You're investing in multifamily, you're going all in, you're going to build a 100-unit portfolio very quickly. You're also investing in Seattle, where a lot of people are scared to invest because of local politicians and policies that are continuing to push a little bit further and further to kind of tighten on landlords. Maybe talk a little bit about how, that contrarian approach and how, this strategy that you've employed that you're having success with when everybody else is kind of running the other direction, kind of, how you're having success in this market when everybody else is
Sure.
just scared.
Yeah, I think to talk specifically about the multifamily asset class itself or asset type itself would be right. Really understanding the idea that if you've got a strong cash flow position with long-term debt, right, in a strong market like Seattle, in a strong neighborhood, that cap rates are going to decompress. That means they're going to go up. So cap rates go up, values come down. That's absolutely happening right now, 100%. Now, the biggest question is how much more will cap rates go up, bringing values down? How long will they be high? And then also, how long will it take for them to come back down? Right. So our historical average in Seattle for I'm operating in Class C, right? So Class C being older buildings, value add, where we need to go and increase rents, do some renovations, make the place look pretty again. So it's almost like a long-term flip, right? So I'm flipping these apartment complex, but instead of 6 months in and out, it's 5 years, 7 years, 10 years, and so. That's, we've got a much longer time horizon in front of us. So we have that ability to pull out of the market or sell rather when when the market is timed well. So right now, cap rates, I was just at an event last night and operators that are far more tenured and far more experienced than I am right now, all operating here in Seattle. The majority of people, one of the surveys that we did was, what cap rate are you a buyer right now? And the vast majority of the respondents said a 6% cap rate, which is astronomically higher than the historical average of 4.5 to 4.75. So why is it so high? It is high because our cost of capital is high. And I think that certainly as the market continues to go in this tumultuous path over the next 9 months, 12 months, we will still continue to see that 6 to probably maybe 6.25. But pretty quickly once the interest rates start coming back down, which we do believe that they will, I think it's going to be more like early 2025. When that starts happening, right, and we hit that soft landing, whether we hit the soft landing or not, we'll see. But if we're getting that soft landing in 2025, supply is also coming down in 2025. I see that our cap rates, our valuation metric is going to be back closer to that historical average in a 6, 9, maybe even a 12-month at most basis. So that puts me at the end of 2025 back in our historical averages of 4.5 to 4.75. And as long as I've got debt terms that exceed that by a decent margin, 2 to 3 years beyond that, man, we're sitting great. We're in a great position because again, we own a cash flowing asset right now. We own a cash flowing asset right now. We have debt that gets us beyond where the cap rates will come back down, and then we can sell it at any point after that. So gotcha. The multifamily asset class, right, we're going to continue to see pain over the next 6 to 9 months. It's going to be a buying opportunity. We will certainly be buying multifamily, but the how is the most important part, which again is get your cash flow immediately and have debt terms that exceed the decrease of interest rates.
Right. Yeah. So the point Karl raised in terms of long-term debt, right? That's something that I learned as a first-time syndicator. I kind of committed a cardinal sin of syndication is I did a 3-year fixed term thinking I was going to come in with a 70-unit apartment, get it turned around quickly, refinance out. And what happened was we got 2 years in and then COVID happened. So we immediately went to 50% economic occupancy. The building was still half full, or it was still full, but half the people were paying. So when I went back to the bank and tried to refinance, they said, nope, you're going to have to either get this thing turned around or put more money into the deal or, risk losing it. So thank God we were able to get a 1-year extension, and we were able to, work with those tenants and get our occupancy up to actually be able to refinance. But what would you tell or what would you say, Karl, for somebody that's trying to understand those differences between commercial 5+ unit or residential, 1 to 4 unit, and like if they're trying to get into that space, what would you tell them to watch out for as they're going through
definitely the variable rate debt is just atrocious, right? I think right now it's easy to avoid that because it's on the headlines everywhere. Right. Syndicator had 3,000 units in Houston on variable rate debt. They can't make their payments. That goes back to the lender. Boom. There's tons of those stories. And so I think, again, don't be tempted by cheap, relatively cheap money in lieu of your business plan, which your business plan should be long-term fixed rate debt that gets you past the interest rate anomaly that we're going through right now. Going from residential space, everything is typical. If you're flipping, it's usually 12 months, right? 12-month loan term. If you're on a long-term DSCR loan or primary homeowner loan, you're talking 15 minimum, 30-year balloon, or 15 to 30-year balloons, right? So your payments due in 15 or 30 years. You either have to sell it, or you have to refinance it, or you just continue paying it and you pay off the principal. Now on the commercial side, it's radically different, right? So like you said, Ian, you can get a 3-year fixed rate loan. For me, everything's been 5-year minimum fixed rate loans. You can go 7, you can go 10-year is the most common between there. I think that they've got some very few, but some 20-year loans. And if you're operating in HUD type products, you can actually get 40-year balloons and 40-year amortized loans. So those are also interesting, but obviously when you're dealing with a HUD loan, you've got a ton more restrictions like senior housing, affordable housing, and so forth and so on.
There you go. So
and just to add one more point, I think the easiest way if you're transitioning from residential to commercial, go get a broker. Go get a mortgage broker, right? There's tons of them out there. They will help you find the best product for your business plan. As long as you've got an asset, you've got an apartment, you're really excited about it, you want to do it. These are the things you want to do to the property. Now, you just have to find the debt. Go find a mortgage broker, convey to them clearly what your business plan is, and then they will help you find and they will help place for a fee. The fee is worth it, but for a fee, they'll find the right debt product for you.
Yeah, that's great advice. And one other thing that I've seen through my commercial experience is when you're working with those lenders or brokers, they're going to actually underwrite that deal for you, which essentially gives you an extra layer of comfort that deal pencils and is going to work. Because if you go buy a residential deal, that's based on your own personal income statement. Whereas, these large apartment deals, they're going to be underwritten based on the income and expenses of the property itself. So any lender that looks at that deal is going to look at you as the operator, but they're also going to make sure that the deal pencils and makes sense.
100%. So
that, it's nice to have that extra set of eyes, especially with a trusted mortgage broker that you've worked with in the past.
For
sure. So where do you see gold multifamily going, Karl, in the next few years? And what are your aspirations? You mentioned the 100 unit goal. Do you want that to be in Seattle? Are you looking national? Or kind of tell us a little bit about your next steps?
Yeah. So I think the next step is continue to hire. So right now I've got a team of 3 people and continuing to hire on folks to help the existing assets and then continuing to grow the brand. And I think the next step is continuing to double down in the Seattle market. I think that we've got a ton of opportunity, right, with lack of competition in the apartment syndication space. And I think it's doubling down in this market, continuing to buy high-quality assets in incredible locations, operating them incredibly well, exiting those assets in the 3 to 5 year time frame. But, expansion certainly is going to happen at some point. Expansion outside of the city of Seattle, outside of the region of greater Seattle region, outside of the state of Washington. It's certainly going to happen at some point. But right now, I still see enough opportunity in our region to not need or not be tempted to go out of state. So it will be to continue to grow a world-class, vertically integrated company to where we are able to offer property management in-house. We're able to offer construction services in-house. At some point, we have brokerage services in-house, right? We're buying and selling our own assets. And then eventually at some point after that is building a capital markets team, right? So the capital markets team would be, instead of having to go out and hire mortgage brokers to do all this work, we have a dedicated staff to be able to say, hey, we have the ability to go out and find and source our own debt. And, once we get to that point, then you can start thinking about commercializing your services, commercializing your property management services. So offering it to Ian Loves Real Estate as another operator. And it's us saying, hey, we'll do property management services for you. It's kind of the run of the mill in terms of pricing. And what is that going to do to us? It's not necessarily going to increase our revenue radically, but rather it's going to cover a lot of those fixed expenses. And so that can go across your property management services, that can go across your construction services, and your capital market services.
Okay, that's great. I mean, I'm excited to see that come to fruition for you. I have no doubt that you'll accomplish that.
Yeah.
And for people that are watching right now and listening, when we talk about getting into the bigger apartment deals, one of the best ways that you can do that, and I know how I started, was by being a limited partner, which is essentially a passive investor, into somebody like Karl's, who's had the experience, understands the numbers, has a team built out, and can kind of show you the ropes in terms of that multifamily space. So definitely, if you're interested and not really sure if this is a great time to invest in single family, or you don't have quite enough money to go buy a deal at 8% rates, looking at potentially investing in somebody else's multifamily such as Karl's is a great way to learn and kind of cut your teeth in that investing space.
Yeah, I appreciate that.
Yeah. So what would you say, for folks that are, on the sidelines right now, but really want to get in, and the market's kind of at a gridlock right now because we've got these 8% rates, sellers aren't selling, buyers aren't able to afford what they used to, and inventory is just completely, lower than it's been in 20 plus years. What would your advice be for somebody trying to get into the real estate market right now?
I guess that my first question to them is, why do you want to get into the real estate market right now? Why right now? And and then what do you want? Where do you want to go with it? Right? Is it, do you just want to test? Do you just want to flip a home because you've got an extra $150,000? Do you really truly? What's the idea? And there's this idea, this image of drinking on the beach, alcohol on the beach, passively. You've got $10,000 of income coming in from all of your rentals. You don't have to lift a finger. None of that's really true. But I guess my question is, why now? Why real estate? Really, truly making sure that the person understands the space. And then I would say a couple things. Make sure your money's working right now as hard as possible before you even get into your real estate deal. So, your $150,000. Make sure it's in some kind of high yield money market account. Make sure it's in some kind of liquid type of investment to where you can pull out. I'm not talking about stocks. I'm not talking about where you can lose the face value of your principal, but rather something again like a money market where you're 4.5 to 5.25, depending on your banking institution, somewhere with decent yield on the principal. But you've also got hyper liquidity to where when you do find a deal, you do find an investment, you can pull it out and put it into that deal. So that's, I would say, the first step is making sure that your money is working while you're waiting or while you're looking. And then it's going to be, again, what really truly, what is your appetite for risk? Do you want to be, do you want to be negatively leveraged? Meaning, is cash flow super important to you? To me, it's absolutely critical. It has to cash flow. That's my margin for error. So I would say to somebody new, go find a cash flowing asset. Go find a duplex to a quadplex. It's probably going to be the easiest thing for you to get. I would also say, if you can afford it, a 5 to 10 unit, depending on where you're at, 5 to 10 unit apartment could also be a good option. But ultimately, it has to cash flow. You have to have long-term debt of at least 5 years at this point. And make sure you've got good, solid partners on there. Property management, mortgage broker, a real estate broker as well would be helpful to help you navigate that process as well.
That's great advice. A lot of people feel that pressure to get into the market. They go to these meetups and they listen to podcasts and I got to get in now. And, sometimes the best move is no move, right? Yep. So getting smart, understanding the market and really finding out what is a good deal and really just learning so that as you are stacking cash in that 4 or 5% money market fund, that when the deal comes, you can jump on it because the good deals are still out there, but you've got to jump on them and.
So there's two terms that I would call out would be analysis paralysis and FOMO, fear of missing out. So Don't let the two of those, don't confuse the two of those, right? So analysis paralysis, you could probably, if you're doing it the right way with the right partner, with the right mindset, it should take you no more than a month to find a good deal. Right. If you're doing it the right way, if you're doing it for the right amount of time, then you should not take more than a month to get a cash flowing asset in a good location, at least under contract. But do not let the fear of missing out force you into a deal that simply just doesn't pencil. Right. And so don't make these oversweeping assumptions that you say, I'm going to be able to get into the Seattle apartment. I'm going to increase rents by 40% in the first year, and it is going to be a home run. Not going to happen. Don't let the fear of missing out get you into the wrong deal.
For sure. Couldn't have said it better myself. So, Karl, where can folks find you if folks want to reach out and learn more from you?
Sure. So LinkedIn, I'm hyperactive on the LinkedIn space. I love LinkedIn. I think it's a great area for W-2 employees, for people looking to grow their professionalism within a kind of a corporate space. There's a lot of real estate on there as well, obviously, and investments as well. So I talk a lot about macroeconomics. I talk a lot about real estate. I talk a lot about microeconomics, meaning the Seattle market. And that is where I am most active from a social media standpoint. Also have Instagram. And then lastly would be the most obvious, my website, gold-mf.com. So Gold Multifamily is the company. That's gold-mf.com.
Awesome. Well, we've had a great conversation. I really appreciate you coming on. We can't let you go without asking the question that we love to ask all of our guests. Karl, why do you love real estate?
I think the idea to me about real estate is just the ability to more easily control my destiny, my future. I look at any of the other business building ventures, and there's a lot of them, but I think ultimately they all can point back to real estate being part of every single business. E-commerce has some real estate aspect to it. Drop shipping has some kind of real estate associated with it. So if I can become a master over the next 5 to 10 years in the real estate space, I can then take that knowledge and experience and go drop it on any other industry pretty easily. And a lot of the transferable skills as well.
I love that. Awesome. Well, thank you, Karl, so much for coming out today. Really appreciate it. Everybody go check out Karl on Instagram, LinkedIn. His LinkedIn information is great on macroeconomics and everything that you need to know about real estate. And I'm sure he'd be happy to sit down with you, learn more about that multifamily space that he's having so much success in Seattle. So thank you, Karl, and we'll talk to you soon.
All right.